Good morning, everyone. What we're going to do today is similar to what we've been doing, but we're going to look at a couple of variations before we move on to something new. So this is just a different type of linear programming model. Recently, in the last couple classes, right before the exam, and last time as well, we looked at dietary examples. Putting together a correct diet given restrictions, knowing we also had to look at things like requirements from X amount of products. We did it for a dietary example 2 times. And then last class, what I did was I solved the dietary example using Excel and QM for Windows. We're going to do something similar here. We're going to look at these examples from multiple perspectives, both Excel and QM. But in this situation, we're going to start with QM. This is an investment example. This example can be found on pages 142, 143, 144, and 145 of the textbook. But the basic idea, and I'll read it for you now, is that Kathleen Allen has $70,000 to divide among several investments. The different investments are A, municipal bonds with an 8.5% annual return, B, certificates of deposit with a 5% return, Treasury Bills with a 6.5% return, and a growth stock fund with a 13% annual return. These investments will all be evaluated after 1 year. However, each investment has different levels of risk. Kathleen wants to determine how she can make the most money while also following several restrictions or constraints. The first one is that 1, no more than 20% of the total investment should be in municipal bonds. Number 2, the amount invested in certificates of deposit should not exceed the amount in the other 3 investments. Number 3, at least 30% of the investments should be in Treasury bills and certificates of deposit. And number 4, to be safe, more should be invested in certificates of deposits and Treasury bills than in municipal bonds and the gross stock. And the ratio on that should be 1.2 to 1. So we're preferring Treasury bills and certificates of deposit. This might be a little hard to understand now, but I will update the example, with photos in our group chat. So let's begin. We clearly have in this situation, well, as always with QM, we're going to go to Module, Linear Programming, for now, and open a new file. We know we have 4 decision variables: amount invested in municipal bonds, amount invested in certificates of deposit, amount invested in Treasury bills, amount invested in the growth stock fund. So we have 4 different variables. Constraints, well, we just went through that. So the first one is that we want X1, or 20%, should be invested, no more than 20% invested in mutual funds. The next one is the amount invested in certificates of deposit should not exceed the other three choices together. The third, we have a situation where, excuse me, we have a situation where we've got to look at it in terms of 30% of the investment should be in Treasury bills and certificates of deposit. Because 30% of 70 is 21,000, we can formulate that correctly. The fourth is that the ratio of the amount invested in certificates of deposit and Treasury bills to amount invested in municipal bonds and growth stock should be 1.2 to 1. Now, these are basic, relatively basic to formulate. However, because we're fitting them into our computer programs, we have to alter them in a couple different ways, because the way we would formulate it isn't exactly the way it would enter into the computer. So let's begin. We have, in this situation, 4 different constraints. And we know that we're trying to maximize return on investment. So we click over here to OK, and we begin. So first things first, we'll make this a little bit bigger because they're going to be, our titles are a little bit longer today. So our first possible choice is, or X1, as we mentioned before, X1 is municipal bonds. And that means savings bonds issued by the city. Our second alternative is certificates of deposit. And that's money essentially invested in a bank, put into the bank. Our third, Treasury bills. And those are investment certificates issued by the government. They're a little more trustworthy. And finally, the last one is a growth stock fund. So this is a fund that we give them money and they will invest into the real estate or into the stock market for us. So these are our 4 different alternatives. Now, the first thing we need to know, we're trying to maximize. So if we remember from the question, what are we trying to maximize? We're trying to maximize our return. We want to generate as much money as possible. So what we're going to do in this situation is we're going to, instead of money down here, or here, here, or here, what we're going to enter is the actual amount or the rate of return we expect. So we know that, number 1, the amount invested in municipal bonds, there's an 8.5% return. So we make that 0.85. In this situation, because we're dealing with percentages, it's very important that we're very careful where the decimal goes. 0.085 and 0.85 are intensely different. So we have to be careful. Why did it round up? Wait a second. Point 0. Oh. There we go. For some reason, my QM had defaulted to 2 decimals right here. If that's happening, all you have to do is enter the decimal places right in this location. Certificates of deposit. Here again, we know it's a 5% return. So this becomes 0.05. Treasury bills is a 6.5% return, so 0.065. And the growth stock fund is a 13% return. So we make that 0.13. And that's what we're trying to maximize. We want that number, when all things are considered, to be as high as possible. It's not telling us how much money we're going to make. It's going to tell us our rate of return. For every dollar invested, we will see that much return. This is a little more complicated because it's not quite as straightforward. So it is important, if you're unclear, to maybe watch this 1 or 2 times. The reason I'm recording this is because as things get more complex, it will be harder to follow along if you are unclear in what we've done in the past. So please be careful. If you're unclear, try to rewatch it. And if you're really unclear, feel free to contact me. I am available for help. So our first constraint is that no more than 20% of the investment should be in municipal bonds. So a maximum invested, so max municipal bonds. So in this situation, we know the maximum we invest in municipal bonds is 20%. So this is requiring some basic calculations. But what we would figure out in this situation, let's pull up our calculator. Right, calculator. So we want our maximum invested of 70,000 is 20%. So multiply by 20% and we get $14,000. So we know the most we can invest in municipal bonds is $14,000. So we'll minimize that. Municipal bonds is here. So if we're saying in general municipal bonds, we make that quite simply a 1. 1 must be less than or equal to $14,000. That's our first constraint. Now our second constraint is a little more complicated. Our second constraint is that the amount invested in certificates of deposit should not exceed the amount invested in the other 3 alternatives. So that means X2 must be less than or equal to X1 plus X3 plus X4. X2, the amount invested in certificates of deposit, should not be greater than the other 3 combined. So here, CDs must be less than or equal to municipal bonds plus treasury bills plus gross stock. But that doesn't really work in this format. Because it's the computer, we need to alter that equation. So what we're going to do is make it X2 minus X1 minus X3 minus X4 must be less than or equal to 0. That's what information we'll get here. So we'll go 1 minus 1, minus 1, minus 1 is less than or equal to 0. So this, subtracting this, this, and this, must be below 0. It's a little complicated, but hopefully when you're looking at the question, it becomes a little more clear. Now the question in the textbook isn't solved in QM, it's solved in Excel. That's why we're doing it in QM first. And I will come back and look at that with you a little bit later in Excel. So here we are, moving on to constraint. Constraint number 3 is, let's title it CD, Certificates of Deposit. Is not greater than 1, 2, 3. 1, 3, 4. That's what we've shown here. Certificates of deposit is not larger than municipal bonds plus treasury bills plus growth stock. Moving on to our third constraint. And here we're going to have to manipulate a little bit again the equation. Our third not this one, sorry. Our third constraint is that 30% of the investment should be in treasury bills and certificates of deposit. So we have to go back to our calculator. We need 30% of 70. And again, this isn't very complicated. We could have done the math in our heads, but it doesn't help us, or doesn't hurt us to look at the larger picture. So what we found here is that 21,000 is 30% of 70. So we minus this. We know it's going to be 21,000 here. And what we know is that constraint number 3 is that 30% should be invested in treasury bills and certificates of deposit. So that is X2, certificates of deposit, plus treasury bills must be greater than or equal to 21,000, because that's our minimum amount we require in those two fields, in those two investments. So now we've ended up with a situation where we've put in all the examples, but it's a little different than what we've done in the past. Because we see here, we're not really entering numbers. It's 1, minus 1, 1, 1, 0, 1, minus 1, 1, 1. So we have to title our third constraint. So that's minimum CD plus TB. Our fourth constraint is that the ratio invested in certificates of deposit and treasury bills to the amount investment in municipal bonds and growth stock should be a minimum 1.2 to 1. Now, there's a couple different ways we can do that. Essentially, we'd have X2 plus X3, which is certificates in treasury deposit, divided by X1 plus X4, municipal bonds and growth stock, would be greater than or equal to 1.2. And again, you'll see a little bit of that when I do send the information along in the textbook. But that's not, again, the standard format. So what that becomes is X2 plus X3 is greater than 1.2x1 plus 1.2x4. This is a basic algebraic transformation that we would have studied in the first half of this class, but will govern a lot of what we do in the future. These basic algebraic transformations are what allow us to manipulate the formulae, so that they fit into the standard acceptable computer format. So moving on, we see that, we'll say this, the ratio invested. That's what we'll title it. So we have minus or 1.2x1 minus 1.2x4 and positive certificates of deposit, positive treasury bills must be greater than or equal to greater than or equal to 0. Meaning the total must be above 0. That will give us the correct ratio. Now, looking at everything we've done so far, we've kind of put everything together, but we have one more situation. And that's, so what we have to do is we're going to have to alter this, because we didn't think of one thing. And I purposely skipped this step so that we could look at how to correct mistakes if they've been made. We're going to insert a row. Why a row? Well, a row is a constraint, and we forgot one constraint. So let's do that now. Our new row, one second, is that our investor, she doesn't want to leave any money in the bank. She has $70,000 to invest. She wants to invest all of it. So we'll title this Total Invested. And here, it is quite simply 70,000. So we have 1, municipal bonds, plus certificates of deposit, plus treasury bills, plus the gross stock fund must equal 70,000. That's all we have. We don't want less. We do not want more than that. So now we have these 70,000. We are, because we're using QM, we're in a scenario where we can, right now, quite simply, use the solve function. So we hit solve. Let's expand our window a little bit. And what we've shown here is that we're going to invest nothing in municipal bonds. And that's okay, because our only restriction was we had to be less than or equal to 14,000. 0 is less than 14,000. This is acceptable. We also know treasury bonds must be 0. Sorry, not treasury bills. Certificates of deposit, we see right here, we're also investing 0. So of the 70,000, we're only choosing 2 investments. 1, treasury bills. We're going to invest $38,181.82 in treasury bills. The growth stock fund, we're in a similar situation. We're going to invest $31,818.18. This means altogether we're investing 70,000. But these 2 options are the superior choice given these restrictions that we had. And in total, they will return to us $6,618.18 after 1 year. So our 70,000 becomes $76,618.182. This is a classic investment example. The only complicated thing when using QM in this scenario is finding a situation where we're able to manipulate the basic English using algebraic transformations into a format that QM accepts. So hopefully everybody's followed along, and it should be a little more clear when I've provided some screenshots from the textbook. However, if you do have the textbook, again, this is an example given to us on pages 142, 143, 144, and 145. Hopefully there are no questions. So let's take a short break, and then when we come back, we're going to move on to the next level, which is solving this same equation in Excel, because mastery of both programs is, at this point, very important moving forward. Hello everyone, and welcome back. In this second section, what we're going to focus on now is Microsoft Excel. And by that I mean in the first section, we're going to do the investment example again, but we're going to do it here in Excel format because one, it's important to have mastery of both formats. Two, it's not quite as simple as using QM. QM is excellent now. It does have limitations, but for now, it offers a lot of advantages. The primary advantage is that it is essentially plug and play, meaning once you have your constraints and once you have your decision variables decided upon, all you really have to do is plug the numbers in. Once you know how many constraints, once you know how many how many decision variables, it's very easy to figure it out. And as I showed in the last section, even if you don't correctly interpret the number of constraints or the number of decision variables immediately when you begin the problem, it's as simple as going back and adding a row or a column. Once you add a row or a column, you just alter the formula. QM adapts seamlessly to that situation. QM has no problem altering its behavior immediately to reflect the new realities of the problem. Microsoft Excel, though, can be a little bit more difficult to work with. So first things first, I'm going to show you how to enter the investment example in Microsoft Excel. And this, as I mentioned, can be found in the textbook on pages 142, 143, 144, and 145. Then, once I finish this, we're going to move immediately into one additional type of analysis, a marketing analysis. So we will have looked at, by the end of today's class, we will have covered 3 distinct modeling examples. We'll look at a dietary example, or we will have looked at a dietary example, an investment example, and a marketing example. Next week, we'll wrap up this basic section by looking at a transportation problem. But for now, let's begin. So we know, let's title our worksheet just to make it a little bit easier. We'll call it the investment example. Now, we know in this situation, we're not looking for products. Oh, as always, my mistake. Let's make these a little bit wider. There we go. All right, the investment example. Previously, in this section here, we've always titled it product. But in this situation, again, doesn't really matter. But for simplicity's sake, we'll call it investments. And again, previously where we had written all our products, what we're going to do in this situation is we're going to write in our actual investments by name for clarity. So the first one, municipal bonds. And as stated, those are savings bonds issued by a city. Our second investment is certificates of deposit. This is money that we enter into our bank account and allow the bank to invest for us to grow our money. Our third investment is Treasury Bills. These are similar to municipal bonds, but instead of being issued by a city, they're usually issued by the federal government, the country of X. Finally, we have our growth stock fund. Now, these are our four possible decision variables. And if we recall, a decision variable is the choice we are attempting to make. Above and beyond that, there are our perfect choices we are attempting to make based on what we want, what our ultimate goal is. The goal of linear programming is to make choices without bias, without opinion entering into the situation. That's what we're doing here. We're making these choices based on not how I feel, not what I think is the best investment, but what the mathematics show is the best investment. So let's begin. The first thing we have to know is what our return or rate of return would be. With any investment, we don't want our money back. That's a losing investment. We want to make money. So if we have a rate of return, the higher, the better. The more I invest, or whatever money I invest, a higher rate of return means I'll get more money back. My base amount plus X more. So a higher rate of return is a bonus. Now these are given to us in the example, and they're based on statistical averages. Each of these investments generates X amount of return, or has returned X amount over a period of time. So we don't necessarily know that every investment will equal exactly what we expect, but we can hope that that is the case based on historical averages. So with municipal bonds, we know that traditionally a municipal bond returns 8.5%. And 8.5% we know mathematically, at least for the computer, is 0.085. Certificates of deposit. Traditionally, at least in the scenario proposed by the textbook, have returned 5%. Treasury bills have traditionally returned 0.65%, 0.065%. Again, a very important difference. And finally, a growth stock fund returns 13% or 0.13. Now, the reason we use linear programming is if we look at these numbers, 0.085, 0.05, 0.065, 0.13, we know clearly we should invest everything in the growth stock fund. It is more than double certificates of deposit. It is exactly double treasury bills, and it is significantly better than municipal bonds. That's the easy choice. If I wasn't using linear programming and I was basing it on my gut instinct, probably my best bet would be to invest everything in this scenario. Invest everything in the growth stock fund. But that would be a mistake because we have, as we've come to call them, restrictions or guidelines. The first guideline, and these guidelines were given to us in the book, is that no more than 20% of the total investment should be in municipal bonds. We don't want to be municipal bond heavy. We want to restrict it to 20% of the total investment. So we do that, again, by knowing that 20% of 70,000 is 14,000. So maximum and we'll leave it at that right now. Maximum municipal bonds is 20%. We'll expand this column a little bit so that we can read it a little easier. And as we get more complex, it doesn't hurt us to bold some of our important columns, because these will get harder and harder to read as we get increasingly complex. So our first one is the maximum municipal bonds is 20%. Our second is that the amount invested in certificates of deposit, so CDs, should not exceed the amount invested in the other three alternatives. So CDs should not be greater than municipal bonds plus TBs plus growth stock fund. Oh, let's unbold that one. That's silly. All right. And what we've done here is we've taken the phrase, the amount invested in certificates of deposit should not exceed the amount invested in the other three alternatives. And what we've said is CDs, the amount invested in certificates, must be less than or equal to municipal bonds plus Treasury bills plus the growth stock fund investments. Let's move down to our third restriction. And in English it says at least 30% of the investment should be in Treasury bills and certificates of deposit. That's the minimum. So we're going to say minimum TBs and CDs. And that is 30%. Again, the more complex we make these titles, it can be a little confusing right now, but we want to be in a scenario where we know what our minimum is. We know when we look at it exactly what we're actually trying to determine. And that's what we're doing with these more complex titles. So let's move on to number 4, our fourth constraint. And it says in English, to be safe, more should be invested in CDs and Treasury bills than in municipal bonds and growth stock by a ratio of 1.2 to 1. So that is a little bit unclear. Well, let's see if we can't make that more clear. So what we're saying is CDs plus TBs should be more than, I'm going a little slowly because I would like everybody to follow, more than the amount invested in MBs plus growth stock funds. So what this says is that the total of CDs plus TBs divided by the total of MBs plus GSFs, and that's the ratio. The ratio must be greater than or equal to 1.2. And that's what we saw from the question. Now this is unclear because it's the first time we've looked at it. But if we saw a lot of different examples like this would become pretty clear. Essentially it means CDs plus TBs divided by MBs plus GSFs. So the ratio of these two must be greater than or equal to 1.2. Finally, we have a final restriction, and it's Kathleen wants to invest the total of $70,000. So our total investment. And again, we'll come over here, just as we always do, and we'll call it available constraints total. Total available. This one is actually usage. Now that worked before, but this is what we've done so far. But let's look at these three. Do they necessarily make sense in this situation? Maximum municipal bonds usage doesn't really make sense. So as we get into more complex situations, we might want to change these. So let's make this one into achievement. How much we've actually achieved. And instead of constraints, let's call them restrictions. And over here, instead of total available, we're going to call it requirements, because that's actually what we found. So we know that achievement we can't really enter yet. Restrictions we kind of know. So our maximum municipal bonds is 20%, meaning it has to be less than or equal to 14,000. In terms of the second one, we have our limitation. CDs must be less than or equal to MBs plus TBs plus GSFs. So it must be less than or equal to 0. In the third one, we have minimum of TBs and CDs, so it's greater than or equal to, and we know it's 21,000 because that's 30% of 70,000. We know here CDs plus TBs, MBs plus GSFs is greater than or equal to 1.2. So in this situation, we know it's greater than or equal to 0. And the last one, because total investment must be exactly 70,000, it's equal to 70,000. Achievement, we'll get there. That's where we enter our formula. But in terms of the rest of them, let's go in and enter some of the information. What we've done here so far is all we've done is right now we pretty much completely from the beginning recreated our initial board that we saw in QM. This is the QM board. Minus, if we take away this, the achievement, this is the base QM board. That's all we've done so far. So we know that maximum municipal bonds, which is 1, must be less than or equal to 14,000. These 3 are unaffected. We could leave them blank. We can make them 0. It doesn't really matter. In the second one, we know that the amount of CDs must be less than or equal to MBs plus TBs plus GSFs. So if we change that, if we make that into a mathematical formula, what we would have is CDs 1 minus MBs minus TBs minus GSFs must be less than or equal to 0. And that's a simple algebraic transformation. So how do we enter that here? CDs 1 must be less than or equal to municipal bonds, less than or equal to treasury bills, less gross stock, must be less than or equal to 0. If we take this information and we move MB, TB, GSF to this side of the equation, we have CDs minus MBs minus TBs minus GSFs less than or equal to 0. So this equation played out exactly right here. Here again, minimum TBs and CDs is 30%. So we're only talking about TBs and CDs. So MBs is 0. CDs is 1. TBs is 1. And gross stock fund is not included either. So that is 0 again. That means the total amount in certificates of deposit plus the total amount of treasury bills has to be greater than 21,000. We have to invest more than 21,000 in those two stocks combined. Here again, CDs plus TBs divided by MBs plus GSFs is greater than or equal to 1.2. Once we change this around, and the reason I wrote it in this formula is because it's easier to see the transformation. What this becomes through a simple algebraic transformation is CDs plus TBs must be greater than or equal to, if we move this to this side, must be greater than or equal to 1.2 MBs plus 1.2 GSFs. So we have CDs plus TBs greater than or equal to 1.2 MBs plus 1.2 GSFs. We bring everything over here total, and we have CDs plus TBs minus 1.2 MBs minus 1.2 GSFs is greater than or equal to 0. So that becomes minus 1.2, 1, 1, minus 1.2, greater than or equal to 0. Finally, total investment, 1, 1, 1, 1. That means between these four, it must equal 70,000. So the total invested in these four combined must be exactly equal to 70,000. That's what we've seen so far. And all we've done here is we've entered the information we took from QM and we put it here into the Excel format. Now we'll see later, Excel is good at some things, but for these very simple questions, it's usually easier to use QM because we're not finished. We have to come down here, and what we're looking for is our returns, not profit, but return. First one, municipal bonds. That we'll make this bold too, so it's clear. The next one, certificates of deposit, Treasury bills, growth, stock, fund. And our final goal is total return. So these are essentially everything is completed now, but we need to add a couple things. Specifically, very simply, what is our end? We need the formula entered into each appropriate equation. So total return is equal to this rate of return times total municipal bonds plus this rate of return times total number of certificates of deposit plus this rate of return times total treasury bills plus this rate of return times growth stock fund. Right now it will be 0 because we haven't invested any money. Achievement once again. So how much is it going to be is equal to this times this total, or the number of municipal bonds times the number of municipal bonds plus, and I'm going to do the formula for simplicity to be clear, but we could end it here because the other three are 0 and will not impact the equation. But for simplicity's sake, I will do it. And again, we hit enter, it will be 0 because we have no municipal bonds yet. We repeat again. Oh. Continuing on. Again, this does get a little bit annoying for me as well, but there's really no way to get around it. That is one of the drawbacks of Excel. There are faster ways to do this, but I prefer to be thorough and clear for you. And the last one. We hit enter, and there we go. Our base document is now totally and completely ready. What we have to do now is very simply click on the data function, go over to solver, and enter our key information. So the first thing we're trying to determine, total return, B17. We know it's a maximization. At this point, we should know exactly what's happening here. When it says by changing variable cells, what we're looking at is what will the computer experiment with to find our ideal solution. In this situation, be 13, 14, 15, and 16. We make it simplex LP, and we're going to add in our variables. The first constraint is very clearly achievement must be less than or equal to 14,000. Achievement must be less than or equal to 0. Achievement must be greater than or equal to, and it's very important to pay attention to the sign, 21,000. Achievement must be greater than or equal to 0. And finally, achievement, which is the total invested between all four stocks, must be exactly equal to 70,000. So we've got our 5 key constraints. We know which variables the computer is going to experiment with. We know what we're trying to determine, our total return. We know it's a maximization. So we hit solve. All constraints and optimality conditions are satisfied. We hit OK, and what we found is exactly what we found last time. Treasury Bills is $38,181.82. Growth Stock Fund is $31,818.18, and that will generate a total return of $6,618.18. If we invest $70,000 in this manner, following these guidelines, we will get a return of $6,618 above our initial investment. And that is the absolute perfect choice given these conditions. All right, short break, and when we come back, we'll do the last section. Hi, everyone, and welcome back. Rather than continue, I didn't realize how long the first two sections took. Because we're at such an extended section and because there is a homework question, I'm going to wrap up the video here. But your homework question must be submitted before our class next Thursday. Your attendance on today's class will be based on whether you submit the homework next Thursday. I will give specific instructions as well as a copy of the homework question in our group chat. But you are expected to submit it in both Excel and QM format. That is how we will dictate your attendance for today. So this video that I've made, it will be the guiding point through which you can accomplish your homework problems. So hopefully everybody's been following along. If not, you do now have this video as a resource that you can access to double check your progress, I guess. Anyways, have a wonderful weekend. I hope you've learned something today. If you do have any questions, as always, I'm available through Kakao to discuss anything you'd like.